Today, I'm going to be breaking down how the top 1% actually choose their business banks and why most entrepreneurs are making moves that look right on paper but cost them real leverage down the line. And this is why it's not about just picking a good bank. This is about structuring capital access around your long-term strategy because here's the truth. Banks treat you based on how you behave, but it's also based on how their internal systems are set up to reward or restrict your behavior. The right bank positions you for approvals, for scaling, for building long-term relationships that turn into high-limit business credit lines, real estate lending relationships, and more. The wrong bank, they'll hold your deposits, flag your transactions, and worse, when it's time to go for capital, they'll give you the runaround with no real explanation. This is what I see every day with business owners who's never built a real capital strategy. They're running six-figure and seven-figure operations through accounts they've opened in 5 minutes online, never thinking about how it would affect everything downstream. Banks don't just look at your balances, they look at your behavior, patterns, velocity, and here's what they care about: deposit consistency. They want to see you put in weekly or bi-weekly erratic deposits, raise risk flags. Cash flow visibility. Are your deposits clean or are they coming from platforms like Cash App, PayPal, or Zelle that look like personal side money? You don't want to look like a side hustle when seeking funding. Account age and seasoning. Older, well-managed accounts matter more than most people think, and especially when you're applying for lines of credit or internal funding. Balance management. Are you running your account down to the wire to zero account availability every month, or are you leaving reserves? Are your LLC docs and your NICS code in alignment? I'll have more on this in another video, but what you need to do and how your bank classifies will affect everything. So yes, the bank you choose and how you use it directly impacts the capital that you can access later. Let's break this down into tiers. There's tier one. That's the relationship-driven banks. That's community and regional. These are your credit unions, your regional players, and relationship-based banks. Why they matter? Well, because they actually care about you. They don't have a ton of customers, and that means approvals come from conversations and your relationship, not just an algorithm. They'll often be the first to give you a true business credit card, a real line of credit, and a long-term relationship with a banker who can advocate for you. Just some examples of this would be First Citizens Bank, a BMO Harris, local credit unions in your region. Let's talk about the next tier. This is stackable play banks. These are banks you open strategically to spread deposits and build parallel relationships, even if you don't need them right away. They don't always give you the highest limits, but they diversify your funding sources. Here are some examples of banks that are stackable play banks: Truist, KeyBank, Huntington Bank, PNC. If you're playing the business credit stacking game, these are names that you want seasoning with. Tier 3, fintechs, and this is for cash flow only. These aren't bad, but don't get it twisted. Novo, Mercury, Bluevine, they're convenient, they're quick, but they're not relationship banks. You can use them to segment cash flow or automate certain categories, but don't expect to receive 50,000 plus in lines of credit from them. They're not built for that. Now, let me give you the model that I use with capital clients. You got to have a primary relationship bank. This is the bank you show loyalty, high volume deposits, clean activity, in-person meetings. This is the bank that you're building with. Secondary is the stackable accounts, 2 or 3 other banks where you maintain some seasoning. You may only deposit once a month, but you're showing life, you're showing intention. And fintech flow splitters. This is used for automating flows, segmenting vendors, or separating client payments, not for leverage. This three-tiered structure puts you in the position for fund growth through relationships you've already built. When it's time to expand, You're not just starting from scratch. You're collecting on moves you made 6 months ago. Most people open the bank that's easiest or worse. They let their accountant or friend tell them what to do. But capital access isn't just about having a business account. It's about designing an ecosystem where banks compete for your relationship. And if you're in position to scale with options, not desperation. And this is what I help clients do. I'll build the structure, help you clean up your foundation, and align you with the right capital partners so you can focus on execution, not bottlenecks. So if you're serious about scaling, if you're tired of making good money but never feel positioned for the next step for your business, and you're ready to structure your capital ecosystem with precision, go ahead and DM me the word banks or drop a comment with the word banks and we'll reach out to you. I respond to every comment. This is what I do quietly, structurally, and strategically. Now let's get to work. And if you enjoyed this video, go ahead and like and subscribe and even share it with a friend that you know.